you paying more in taxes than the world's richest men, Jeff Bezos and Elon Musk? Surprise, surprise, you just might be.
I never pay taxes. If there's a way not to pay, I never pay.
My friend Warren Buffett pays a lower tax rate than his secretary.
The wealthy are definitely undertaxed relative to the general population.
These same folks are paying taxes at one of the lowest rates in 50 years.
People didn't get rich by paying a lot of taxes, and for some of them, avoiding Uncle Sam has become their favorite pastime. Say what you will about billionaires, but they can be a very creative bunch where their money is concerned.
Yeah, that's right.
Last year, ProPublica, a non-profit investigative journalism organization, leaked a cache of IRS files that contained tax information about the richest people in America. Dozens of journalists and forensic accountants were able to reverse engineer a number of systems that billionaires use to pay much lower rates of income tax than most regular working Americans. Some were so good at working their numbers that they paid no income tax at all, and some billionaire accountants were even good enough to get their wealthy clients classified as low or middle income earners so they didn't miss out on a stimulus check. ProPublica went on to publish 10 of the biggest and most morally questionable loopholes that the IRS files revealed. You probably won't be shocked to learn that most of these loopholes aren't possible for us regular people to take advantage of, but a few of them are. Of the 10 that ProPublica has published, 5 are genuine problems with the tax code that really do justify some policy reviews, 3 are just good business practices that everybody should be doing, and 2 are really just filler that the website needed to get to number 10 because it made for a catchier headline. So it's time to learn how money works, which was sponsored by BetterHelp. Therapy is something that is hard to talk about, especially for men, but you should be the change that you want to see in the world. So I want to talk to you all about my personal challenges with stress and anxiety. Before YouTube, I worked at an investment bank where the expectation was that you would always be available, always deliver perfect results, and always put your project first. It was exciting work, and I don't regret doing it. But truthfully, nobody can work like that without it taking a toll on you. Unfortunately, mental health is an issue that most people never fully understand, and it's difficult to talk to your friends and family about your problems when outwardly everything in your life seems to be going great. Talking to a professional was the only thing that helped me, and I am grateful every day that I took that step. Thanks to BetterHelp, it's even easier these days to get in touch with a therapist from the privacy of your own house. The process is as simple as filling in a confidential online questionnaire and getting matched with one of over 20,000 of BetterHelp's licensed therapists. If you have ever considered that you could benefit from therapy, let me tell you, it will probably be one of the best things you ever do. So join more than 2 million people who have taken charge of their mental health and get 10% off your first month at betterhelp.com/howmoneyworks, which is also linked in the video description. Capital gains are the taxes that you pay when you sell an asset or equity for profit. If you buy a share for $10 and sell it for $100, you will pay a capital gains tax on the $90 in profit you just made. Capital gains taxes are very important to rich people because their fortunes overwhelmingly come from their investments, not from their regular jobs.
Income tax, state tax, inheritance tax, capital gains taxes.
In fact, up until his retirement as Amazon CEO, Jeff Bezos only received an $80,000 a year salary for his work. Most of his money and most of the money of other billionaires comes from the appreciation in the value of the assets they own. The problem comes when they need money. They are still people after all, and they need to buy food, clothes, homes, and fuel for their private jets. You know, the essentials. The simple way for them to get this cash would be for them to sell some of their assets. This is especially easy when their assets are liquid, like shares in a public company. If they do this though, they will have to pay capital gains taxes if the assets they are selling are worth more than what they were purchased, and hopefully, if the billionaire is making good investments, this will be the case. If the billionaire wants to avoid this, they can work out just how much they want to live off of for the year and they take out a loan. They don't pay tax on cash they receive as a loan, and if they put up collateral like the shares that they were thinking of selling, then they will pay a very low interest rate. As an added benefit, if the assets appreciate at a higher rate than the interest rate on the loan, they will actually be better off than before, even considering the tax advantages of this hilariously named buy, borrow, die tax strategy. Unfortunately, the loans that the billionaires use to make this work are only available to the type of people that have the department at the bank dedicated just to them.
Under what circumstances would you be obligated to cooperate with an FBI or or U.S. Justice Department investigation, for example?
Ça dépend.
Ça dépend.
Wait.
The closest thing that regular people will get to this is a home equity line of credit, which in many ways is just a small-scale version of the same strategy. On the topic of real estate, it is the centerpiece of many billionaires' portfolios, not in small part thanks to the amazing range of tax breaks available in this industry. The government wants people to invest in homes, so it has tax policies to encourage investors to give people a place to live. Similar tax breaks are available to oil drilling and farming. It's a good bet that anything that the government views as an essential industry probably has some favorable tax policies written to sweeten the deal for billionaires putting their money there. One of the biggest allowances made to investors, specifically in real estate, is a 1031 exchange. This is a tax rule that lets investors sell investment properties for a profit and not pay capital gains tax on it so long as they use that profit to buy more investment properties within a certain time period. This has let property moguls flip their way to enormous property empires without paying a cent in tax along the way. To make this better for them, they can subtract the depreciation of their buildings from the rental income they make, which means with some clever accounting, they can have millions of dollars in cash coming in completely tax-free. If you think property moguls are bad, they have nothing on the owners of sports teams. These guys are the absolute kings of profiting off something that no policymaker would be brave enough to campaign against.
Nope.
Americans love their sports, and it's a huge industry that makes team owners a lot of money. Voters want to keep their teams, which means cunning team owners can effectively ransom city governments into paying for lavish stadiums for their teams under the guise of being a community center. But the grift goes much further than that. Sports teams are considered a depreciating asset, which means even if they are making a lot of money and actually increasing in value, the owner can claim a portion of what they paid for their team as a tax deduction in the years following their purchase. As if that wasn't good enough, player contracts are often set up in such a way that they are effectively considered a piece of equipment, not unlike a delivery truck or a fax machine. That means that the players too can be counted as depreciating assets, which, despite feeling icky in principle, can sometimes mean that sports team owners can claim depreciation twice on the same investment.
It's a real business. It's not, what's the right word? It's not a trophy asset like it used to be. It has to make money.
One of the smartest things a billionaire can do to avoid taxes is to die. The United States does have inheritance taxes, but there are so many loopholes in it that it's basically not worth talking about. Spouses, for instance, don't pay any inheritance tax on assets that are left to them by their late husband or wife. This is actually a good policy, because nobody wants a widow to have to sell her family home to pay an estate tax. But the IRS files have again shown that some billionaires take this generosity to the extreme. There is a tax rule called the stepped-up basis. What this rule does is that when someone dies and passes their assets to an inheritor, the capital gains gets counted from what the asset was worth at the time of the person's death. For example, say a billionaire made their fortune by investing in Apple in the early 80s. If they sold their shares today, they would have to pay capital gains on almost all the shares' value because it had appreciated so much. Instead, if they simply die, they can leave their shares to their partner or their children, and now the capital gains will be calculated at Apple's current valuation. If the inheritors then sold the shares immediately, they would pay no capital gains taxes at all, saving them millions. But for some billionaires, this is still not good enough. One billionaire, who will remain nameless because I don't want to get sued, inherited an oil company from her late husband in the early 2000s. She then did something you don't see rich people doing often. She told the IRS that the company was worth more than it really was. She did this because within reason, the IRS will agree to the value of a private company, because without being listed on a public market, it is really hard to find out what a company is actually worth. Once the IRS agreed that the company was worth $1.6 billion, she would later go on to sell it for $1.2 billion. Since capital gains were calculated based off the $1.6 billion figure her accountants provided to the IRS, this looked like a $400 million capital loss. Not only did this mean that she paid no taxes, it also meant that she was able to use this made-up loss to offset the income she made from her other investments in the years that followed. I will leave a link to the full story in the video description, because I have not even covered half of it here. It really is a wild ride. We all have to play by the tax rules, but those rules were written for the rich. If there isn't some loophole or scheme that will let a rich person avoid tax or claim an income so low that they actually get government subsidies, then they still have one trick left up their sleeves. They just use their money to lobby the government to introduce new tax laws which will let them get away with paying less. A $50,000 campaign contribution is a great investment if it gets a tax bill passed that saves them millions. A common theme amongst all of these tax loopholes is that they take advantage of systems that were designed to do good. We love sports, and the joy that they bring communities should be supported. We should be building more houses by encouraging investment in them. We shouldn't make people homeless because they need to pay a tax on their husband or wife's estate, and it's not fair to tax people for taking out a loan. These rules are the same for everyone, but they are designed for the majority, not a tiny handful of people that can make sure that these reasonable laws are written in such a way that they can reap some pretty unreasonable benefits from them. Now, if you are wondering why rich people's money should have any say in the ways our laws are written, then go and watch my video on why political lobbying is not considered straight-up bribery. A big thanks again to BetterHelp and their literally life-changing service for making it possible for everybody to keep on learning how money works.
Death and taxes.
Death and taxes?
Yes.
Death and taxes?
Yes.
But an odd pairing.